Good afternoon. The jobs reports definitely jolted the markets there late last week. And this week, it seems like we're getting a little bit more, let's say, deliberation from the markets on what may come next. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. So let's start just as kind of a light recap of last week, but then also pick up where we left off on Friday. So obviously last week, the big news was the Fed. Leading up to that, the markets had been rallying to some degree, and then the Fed press conference and decision certainly added more fuel to that fire. We saw a really good week in the markets last week. And then we finished up. So Thursday, we had shared that. But Friday, obviously, we also had a very important data point come out. We had non-farm payrolls come out. And this number, this is basically jobs added for the prior month. This number was quite a bit lower than expectations and significantly lower than last month, again, in terms of jobs added for that particular month. So after a great week already, this led to an even bigger week to finish out on Friday with a big jump to kind of end the week there in the markets. And all this was basically on the back of course, the Fed press conference, but also, some of this jobs data that we received, because the Fed is watching inflation, jobs, and economic activity. Inflation is still persistent. Jobs in this one particular example might have showed a slight weakening. And then, of course, we'll talk a little bit more about economic activity in our question of the week. But regardless, we definitely saw a bit of a rally there last week. Now, keep in mind, although we have seen a bit of a jump, we're still down from the highs there of July or so of 2023 for the current calendar year. Lately we've seen things kind of stall out a little bit. So we saw this big jump last week, and then really Monday through today, we've just kind of seen, slight ups and downs, but let's just call it pretty dang flat overall. So I think the market is trying to figure out, what this all actually means, what may be next, and, why the Fed might be considering stalling now when after the last conference, it seemed that it was pretty obvious they were going to keep going. This week, we also had a lot of Fed speak following this decision. So I think that might be feeding into this to some degree. A lot of the Fed members have been talking and just kind of sharing their perspective on things. And, many are suggesting a pretty different tune than what we heard from Fed Chair Powell last week there, which it seemed was very much on the flip side of where things have been. In other words, it seemed like it was very clear that they are on the, let's call it defensive side, maybe, really considering raising if the data suggests, as opposed to raising until the data suggests, if that makes sense. Today, we do have Fed Powell speaking on a panel at the IMF. So, that is important to kind of keep in mind as well. So again, just a lot of week of Fed follow-up is maybe a good way to put it. But overall, again, just to kind of recap what we've seen, we saw a big jump last week based on, kind of on the back of the Fed speak, and then also the jobs data that we had on Friday. But this week, markets have basically stalled out as that kind of shine of the Fed meeting wears off. And, again, I think markets are really trying to figure out what comes next, essentially. Coming up next week, before we get to a question on tightening conditions, we have consumer sentiment, we have CPI data on Tuesday, and PPI data on Wednesday. So I think this is also part of why we're seeing the market stall out, is we've got a lot of inflation data coming out next week. And I think it's very likely that the markets are waiting to see what those numbers look like to maybe support or go against, what we heard from the Fed there last week. All right. All this, I guess this question really ties into the Fed as well. So it's clearly a theme. But the question of the week is from Jen. And the question is, has lending standards, or has lending been getting a bit tighter, let's say over the past year or so? And I will share the short answer is yes. And actually the Fed, the reason I said this is tied to the Fed is because last Wednesday, the Fed had actually mentioned this as well. They had shared that there are definitely tighter credit conditions out there in the markets, not to the full extent yet, but they're starting to see that kind of, work its way through the system. I think part of this, if it helps, is due to bank balance sheets, right? The way that their bonds are priced on the books when interest rates have risen and their bond prices have fallen, allows for some flexibility in how that's actually accounted for. But I think the banks certainly may not want to loan out as much given the liquidity that has, I don't want to say dried up, that might be a bit extreme, but the liquidity that has kind of reduced over the past year or so with these significant rate rises. Typically higher rates are good, but given that banks do have a lot of bonds on their books, it has offset things. I think a lot of banks did expect rates to be lower for longer, and so they bought a lot of bonds. And when rates have risen, that asset on their balance sheet certainly leaves for a challenge. And if they're now having to pay depositors 5% or whatever it might be, but they still hold bonds paying 1 or 2, you can imagine how that can be a bit of a challenge. So what does this mean for consumers? I think that this is likely to continue. I think we're seeing it already, right? Higher mortgage rates, no doubt about it. Higher credit rates. It's definitely been harder to get loans. I think this is maybe the starting of that. I think that theme will kind of continue at least through the next, let's say, 6 months or so. Doesn't mean we can't get lending in place, but I do think that things are going to be a little bit tighter. You can expect to pay a bit more interest for what you are looking for, and qualifications might be a bit more strict as well. So this is a really good question, and actually something we've been meaning to talk about for a while, but given the follow-up from the Fed last week, I thought it was a really good time to touch on this. So thanks, Jen, for sending this one in. Well, that will do it for our update here this week. Definitely tune in next week. Again, we've got consumer sentiment and inflation data that we will be breaking apart next Thursday. Have a great upcoming weekend. We will see you next Thursday at 3.